rationalize our investment for a higher yield. So that is the topic today. Now we have seen, we have explained option Greeks, option parameters and all in various webinars. Now today we are just going to brush one or two important features of those option Greek and use that to show you that how you can create a cash market portfolio and then get a higher investment yield. Okay. So, so please bear with me because this is a slightly advanced topic, but if you show interest and take up this matter, then probably you will see very good results and probably you will be very satisfied that with very low investment, then how you are able to get higher return. Okay, so this is very, very important because once you understand F&O completely, then there are you can just construct structures which fits your risk reward as you want. So today we are going to look at, we will go a little slowly because we will use this probably give some examples at all in later webinars also. So today we will be looking at explaining how we can do that. Okay. So now you are all aware of this option segment. So I think we have already highlighted. So what is very important is, first of all, you should understand the importance of what is a call option, what is a put option. I think this we had for so many sessions of what is a call option and what is a put option. So those who are already trading in option or probably who have attended webinars will be aware of the significance or the what a call option is, what a put option is, the pricing, and what are the important parameters that impact a call option price as well as a put option price. So just to brush this one, so these are important things is IV, that is volatility, then time decay. Right, so these are two important parameters which affects the option price. That means the option premium that you pay. So we should understand this in order to probably create an option portfolio. So now let us look at the normal. Suppose what is the present price of the Nifty? Let us say 15,000. Okay. So in cash market, just for illustration, so in cash market, let us say you want to buy 20 shares of Nifty. 20 shares of Nifty, okay, of this particular thing. Then you have to only go to, that means this 20 shares means this is going to be over 3 lakhs, right? 3 lakhs. So immediately you have to look at the ETFs which are available because 20 shares, you don't have, F&O is one contract is 75 shares, okay. Now we will come to it as to how to create 20 shares and all, but just bear with me. Now the first thing that you will do, just suppose if you want to buy the index, if you want to buy 3 lakhs worth, then in that case you will look at say Nifty Bs. Okay, there are so many other exchange traded funds. Just as an example, Nifty Bs. Now Nifty Bs, let us say it is going at 160 rupees. Let us say it is going at 160. So 3 lakhs divided by 160. So how many shares you will buy? Let us say I will buy 3,000, 30,000. 3 lakhs divided by 160. So you will buy 1,875 shares. So if you buy 1,875 shares worth 3 lakhs, then if the price moves up, you make profit. The price comes down, you make loss, and you keep holding the position in case if you don't want to cut the loss. So you wait for some higher this one, and take the trade and do it accordingly. So this is the way normally you approach a cash market situation, a cash market thing. Now, what you want to do is that you want to get a result. So let us say the same case. Now from 15,000, let us say it moves to 15,300. It goes to 15,300. Let us say the market goes to 15,300. Now what have you done? You have bought, this has moved by 2%, right? This has moved by 2%. So 2% if it has moved, then in that case what will happen on 3 lakhs investment, 2% should give you 6,000 rupees profit. 6,000 rupees profit. So in the case of Nifty Bs, that might have gone from 160 rupees which is there, and that might have gone to say 165 or so, some 3% rally would have been there. So 1875 into 5 or whatever it is, 3 rupees or so. Maybe it will have gone to 163 because it has moved this one. So maybe it will have gone to 163. So 160 would have gone in Nifty base to 163 if this has moved to 15,300. So 3 into 1875, you may get something like 6,000. So this is how you normally get it there, right? So now what we want is, we want the same 6,000 rupees profit. Okay, 6,000 rupees profit, but we don't want to invest 3 lakhs. Okay, so if at all there is a loss also, we don't mind accepting this to the same extent. If there is a profit also, we should take it, okay, to the same extent. But only thing is, the only difference that is going to make the profit loss is going to be the same of investment in a cash market of 3 lakhs thing. Only the difference is right now is whether we can, instead of 3 lakhs, whether we can invest considerably lower amount, which could be 50,000, 60,000, 70,000, whatever it is. So whether we can invest only that much and come out with the same result. So because if you come out with the same result, then if the return in market is say 10% and you have invested only this much, then in that case you tend to get a very high return because you have now come down, because see, the return that you get in F&O is multiplied to the extent of the margin that is required for F&O, right? So you don't need to put so much of thing, only 15% to 20% is the margin that you are putting. So whatever that you get in cash market, so probably in F&O, because of the leverage, you tend to get more return if you are profitable. Same thing we want to do it as far as the cash market is concerned. So how do we replicate this particular portfolio so that no, we don't need to invest 3 lakhs? So that is the question. 3 lakhs of investment should be reduced, but I don't mind accepting the same profit loss potential, okay, of this. So then what are the alternatives which are available there? So we are now looking at now you want 20 shares movement, right? 20 shares movement. So that means if the market goes up by 100 rupees, you get 2,000 rupees profit. You get 2,000 rupees profit. So now the same thing I will cut and take you to option. In option, we have already talked about what is a delta. So option has got various Greek parameters. So we have got delta, gamma, theta, vega, rho. So we will just not talk about all these things for the time being. So we will look at delta. Delta is nothing but a probability. That is, if the price moves up by some extent, to what extent the option price moves up. So let us say the asset price or the futures price or the spot price. So futures or spot or futures price, if it moves by 100 rupees, and if the delta of the strike that we have taken is say 20% or 0.2, right? So this should move 100 into, ideally in ideal condition, we should go up this by 20 rupees. Okay. So if we have 75 rupees, so then you will get 1,500. 1,500 rupees, right? So suppose if we want to say 2,000 rupees, then we should look at something like here we got 1,500. So we should, a point 100 into 0.2 is 20, so 75. So we should be looking at something like a 25 delta, 0.25 delta. Then in that case, the price will move by 25 rupees into 75. So approximately that should give us 1,875 or 2,000 rupees. So approximately I am talking about. So otherwise it could be 26 or 27 delta. Okay. So this is how you come out with some conclusion of what you exactly you want to do, right? So now let us look at it slightly differently. Now, okay. Now you want a delta which is 0.25, because if it is 0.25, then for 100 rupees the price should move by 25 rupees, so that you will get a. So all these things are ideal conditions. Ideal conditions in the sense, this is what the bookish condition is. Whether it will move there or not, I think we will look at it, why it will not move and why it will not move. So we are going to explain different types of products that are available for you to choose, and which is good and which is not good. So we are going to list out 3 different types of products, but I am not going to confuse you with all the 3. 1, 2, and 3. Okay. So the first one is going to be, I would say, something like a plain option, plain out of money option. Okay. The second is going to be something like a straddle. Okay. Third is going to be a spread option. So which one is good, which one is not good? We will look at it from different angles. Each one has its own merits and demerits, and which one which will be more ideal and which will be less ideal depending on different circumstances. I will explain to you. So now we are trying to create a cash market portfolio, okay, which gives you something like, for every 100 rupees movement, the stock will give you for an investment of 3 lakhs, the stock should give you, for a 100 rupees movement. Now we would have invested, say, then in that case we would have is around 0.8%, right? So 100 rupees on 15,000 is 0.7% or so. So on a 3,000 rupees investment, you should get something like 2,100 rupees or 2,000 rupees. So here what we want is the same thing. If the price moves up by 100 rupees, so we should get something like a 20 rupees movement, which into 75 will become only 1,500. So we should look at something like a 25 delta to get that. So that's how we should look at this. So you know that in option there are different strike prices. That is, let us say the market now, let us say the price is 15,000. That is the present price, assuming that's the present price. Now we have also seen in option what is called strikes. That is, you have different rate at which you have different price rates at which you can take an option. That is, it's not in futures. If you want, you buy either 15,000 or you don't buy. But whereas in the case of option, you can buy a 15,000 call. If you buy a 15,100 call, 15,200 call, or you can buy a 14.8, 14.5, 14.6. So there are enough strikes. Let us say from 15,000, enough strikes are there. Let us say 14.5 to 15.5 or 16. Something you tend to prefer according to your financial position as well as the resources and other thought process are concerned. So now, at least now you know that a call option is something like buying a futures. Okay. Only thing is, if the price falls down, the loss in call option is limited to the premium amount that you have paid. In the case of a futures, I think whatever extent it falls, to that extent the loss will be there. So when the price goes up, futures make more money because you are not paid a premium. Whereas in the call option also you make money, but that is suppressed or that is buttressed by the premium that you are paying. So probably your return in that particular case can be slightly lower than the normal return that you may get. Okay. So a call option price is something which will get a slightly lower price, and excuse me. Okay. So in the call option price, you will if the price goes up, then you tend to get a slightly lower profit. You tend to get a slightly lower profit as far as call option is concerned. But whereas in the case of a futures, you get the full profit. So that's the difference between the futures and the call option. In the case, if the rally takes place, the futures makes more money. If the fall is more than the premium amount that you have paid, then call option is better than the futures. So it depends on which time what works. We will leave it for the time being. We will not discuss that. But just it is enough to understand that buying a call option is like buying a futures with a profit, lesser profit if the market goes up compared to futures, and if the market comes down, the loss in the call option is going to be lesser compared to the futures. It is a general statement. So now you have got a different strikes at which you can buy a call option. Now when you look at this, if the price is 15,000, if the futures price is 15,000, then if you buy a 15,000 strike, then it's called as at the money, right? So we have also looked at what is at the money, in the money, out of the money and all. So at the money, normally this at the money, if you look at it, delta is 0.5. Delta, I told you, is nothing but a probability. That is, let us say you are at this position. Now you are flipping a coin. Now hundreds of times you flip a coin, then there is an equal chance of almost getting a tail or a head, because when you put only once, probably yes, it could be head or tail. Okay, so 10 times if you put it, maybe there's a chance of 7 times head and 3 times tail. But if you're flipping the coin 100 times, probably it could be 55-45. Okay, either way. Suppose if you're doing it 100 times and 1000 times, then it will be almost even. So okay, the larger number of cases, then probably the probability gets almost equally divided. So that is what we say right now. If the price is 15,000, the probability that the market will see, generally when somebody asks you what is whether the market will go up or down, say who knows. Okay, so that means it's a probability that it can go up or go down. So when you feel it can either go up or go down, then you assign a probability which is equal. So it's a 50% probability the market can go up. It's also a 50% probability that the market can come down. So we normally say this is a delta which is 0.5, at the money delta. So we get it as 0.5. Now, if you keep going towards higher strikes, let us say you now come to 15,500. So 15,500 thing. So now this is higher. This price is higher than the price at which the market is trading now. That is, market is trading at 15,000. Now you are speaking about 15,500, which is far away, which is around 3% or so away from the present price. This is what we call as the out of the money option, right? This is what we call the out of money option. So as we go out of the money, then this delta will decrease. So let us say this delta is 0.25. That means, first of all, the market has to cover this length and then go up. So what is the probability that you are going to make money above 15,500? If somebody says, then in that case, since it is above the present price of 15,000, it has to be lower delta than 0.5, because the probability has to be slightly lower than compared to the present price. So to the what extent that it is lower is given by delta, which is 0.25. And why should this delta be 0.5? Why should this delta be 0.25? I think there are mathematical formulas which are dependent on the volatility in the time period to decay. All these things will be factors in deciding what strike will have a delta of 0.25, what strike is away from 0.5. Because right now, if you are speaking 1 month away, probably 15,500 could be a delta of 0.25. But if you are speaking only 2-3 days left, okay, then if market has 15,000, then even 15,100 or 15,200 can be a delta of 0.25, because as the time approaches closer to decay, then a price which is even quite closer to the present price will carry a higher delta. So the delta over a period of time for the strike prices will keep moving down, closer to the at the money forwards. So the delta right now is nothing but a probability. Now why I am saying this, explaining this is, let us say in the calculator, if you know, this is delta is 0.25. So if you are buying that particular strike, let us say you are buying a 15,500 strike, and let us say the price is 60. Right now for the month end, all these are theoretical examples. So right now, don't refer the option website. In order to make you understand, we are giving this. We will have one more session to give the actual detail of if you are constructed an option, what could have happened probably. Okay. So now let us say you are looking at strike price which is 15,500 and delta is 0.25 and strike is and the price is 60 rupees. So what happens if the price goes down from 15,000 to 15,100, right? 15,000 to 15,100. Now the price moves up by 100 rupees. So if the price moves by 100 rupees, so the delta is 0.25, so you should get a 25 rupees upside, right? 60 plus 25, it should become 85. It should become 85, right? So most ideal condition, 60 plus 25 should become 85, provided the volatility is the same volatility of what this day. Price has moved by 100 rupees, assuming that 100 rupees is the volatility given by the implied volatility of the particular delta which has been taken, because that is the implied volatility which we have chosen for option pricing. Provided the same volatility materializes, then in that case, it should ideally move from 60 rupees to 85 rupees. But this will not happen. This will not happen. That's what I'm trying to say. When you buy a straightaway call option, because we have explained to you that a buyer of an option always suffers from time decay. Always suffers from a time decay. So what should have moved from 60 plus 25 into is equal to 85? Probably it would have only moved to 80 rupees or 81 rupees. It would have only moved out to 80 to 81 rupees. There is chance that it would not have moved to straight away to 85. because of the time decay, probably due to change in volatility. Time decay means, okay, number of days is lessening. Now on Friday, today is Monday, 3 days have gone in between. So that should rob you of the time decay, because if the price is stagnant, say today the price closed flat compared to Friday, that means most of the options would have decayed, okay, to the extent of the time decay of 3 days. Okay, so in option, the most killing part will be a time decay. The reason why I am saying this, if you want to create a portfolio, okay, where probably you have to rationalize your investment, you don't want to pay much of a premium, you don't want to make much of an investment, what are the factors that can work against you, and whether you will be profitable or not is what probably you have to look at it. Now, speaking about this, you have now got as 60 plus 25, you just got 80, only this much, right? So, in this particular case then, okay, if you have only chosen the delta of this, in the cash market, your profit should have been something like 2,100 rupees. But whereas in this case, if it has only moved from 60 to 80, 75 into 20,500 rupees is the profit. So your profit becomes lower than the actual cash market profit. That means you are not replicating the proper portfolio. That's what I'm trying to say. So first of all, you create a portfolio, then check whether it can create the same risk reward like a cash market trade. Now in this particular case, what we need to look at it is, what is the investment? First of all, what is the investment? We have put only 60 rupees. We have put only 60 rupees. That means into 75. One contract is 75. So your investment is only 4,500 rupees. Your investment is only 4,500 rupees. Okay. What was the investment in cash market? It was 3 lakhs. Where is 4,500 and where is 3 lakhs? Right. So you will be happy even to take this particular return. You will be even happy to take this particular return, because you are definitely getting a return which is better, which looks to be, for the return on investment is quite high. So you don't mind even trading two contracts, okay, probably get a profit that probably which you desire in the cash market. So either you just, what you do is, in that particular case, in order to ensure that you get a return which is very similar, you need to slightly go for a, slightly, because here your investment has become quite less, but your profit should have been the same like cash market. It has not been. So you are lagging something like by 20% or 25%. So that means what you should do is, if instead of delta 25, probably you should have taken a delta which is 30 or so. 30 or so might have given you a return, because if you have taken delta of 30, then 60 should have become 90, but because of the time decay, you might have got something like 85. You might have got something like 85 rupees or so, right? So the time decay probably in this particular case would have given you something. So if the market is climbing higher, then probably you should go for a slightly a higher delta than the delta which has been mentioned in the option pricing. Now, if the fall is going to take place also, then in that case you will have a result which is very similar, because you have gone for a slightly higher delta. Your return will be something very similar to the loss which you are going to have in the cash market. So, generally speaking, it is better that you go for a slightly higher delta. So slightly higher delta, in order to get a profit which is very, very similar to the cash market. But will it definitely happen like this? So what are the factors that influence that, and probably what we can do to negate certain factors which may be working against us? So we'll come to that. Now, I told you that in this particular case, now the investment is very less. Instead of creating a 3 lakhs cash market, you have just created a F&O option portfolio with just 4,500 rupees or 5,000 rupees. 4,500 or 5,000 rupees. So your return by doing this in ideal conditions, it should be the same. So if the loss also comes, then the loss also should be the same, right? So this is what we are trying to work out. Okay. So now, does it always happen like that? The question is, does it happen like that? It's a very difficult question. Sometimes it may happen, sometimes it will not happen because of various parameters. So what is the parameter that will probably keep working against, probably hitting us, and whether we can neutralize those parameters? First of all, if you see that, then we can look at a structure which probably can be more helpful for us. Now, say, what is that? Suppose ideally the last one which I showed you, you should have moved from 60 rupees to 85 rupees in the delta 25. The price had moved by 100 rupees. This should have moved from 60 rupees to 85 rupees. Sometimes what could happen is, for a small rise, if for a 100 rupees rise, let us say I'm talking about a 50 rupee rise. If it is a 50 rupee rise, then ideally the same 0.25 delta should have given you some 12 rupees or so. So the 60 plus at least 12 should have been 72, minus some time decay 2 rupees or 70 rupees. At least this is okay. But what probably could happen sometimes agonizingly is, price would have moved by 50 rupees. Instead of you getting 70 rupees, it may be still 60 rupees. So that means you are effectively not in a position to replicate that same cash market portfolio in the case of an option. Why is this happening? If you check that, probably when you did this trade, which is at 60 rupees, IV would have been 25%. Okay. Now IV might have dropped to 24%. So for an option player, what all could work against you? One is the decay, time decay, and another is the volatility. So you need to neutralize this. So what is the what all can neutralize this? So what you should do is, you should think about why the price is not moving to the same thing. Now, let us say this today the market has turned flat, but if you see a lot of options have lost value. Why is it happened? Because of the time decay. I will just show you some example of that. So this is the option chain, right? So what we'll do is we'll look for 25th March. Sorry. Okay. So this is 25th March. Now let us say today the market closed flat, but 15,000 call option, that day it was 14,950, and today it is also 14,950, right? So if you see this one, it has dropped 10 rupees. 14,950, it has dropped 10 rupees, the put has dropped 35 rupees, and the call option has dropped 10 rupees. But if you look at the price, see, price is almost flat, maybe it's something like 17, 18 rupees on the upside. But the put option has also lost value, call option also has lost value, 15,950. Now, if you look at it, let us say a slightly distant thing, probably at something which could have a theta of 0.25. For today, the closed price is some 18 rupees more. So even if you assuming it is a flat thing, then let's say 15,600. If you see, it has dropped by 13 rupees. It has dropped by 13 rupees, right? It has dropped by 13 rupees. So what does it show? There is no price movement, okay? But the option price is dropped. So it has dropped mainly because one is the time decay. Okay, weekends were there, so 3 days of time decay has pulled all these things down, even if the market is quite flat. Okay, one. Second thing, probably a drop in the volatility also. So there are two combinations. Both combinations can happen. One combination can happen. One can go up, one can go down. So you do not know which parameter will go up or down, which probably can create a problem. Okay, but the biggest advantage is you don't have to put too much of money. So 4,500 rupees you put. Now, of course, you don't want to tolerate a loss. So this loss need not be there always. So let us say today this delta might have been has become something like 15,550 or 15,500. So tomorrow probably if the market moves up a little significantly, then there is a chance that you may be able to reclaim this entire loss. Okay. So if the market moves up by 100 rupees, 150 rupees on some volatility or whatever it is, the higher volatility, the chances this could move a little more significantly. Let us say tomorrow the price moves up by 2 days, it moves up by 200, 250 points. Then in that case, this particular loss of what you made today can get neutralized. So the path that it is going to take for you to maintain the same delta is a path which is not known. You do not know how this will span out over this entire period of 1 month. What can be your result? Suppose if I have to say that the market goes up from 15,000 to 15,300, in cash market you would have definitely made something like as I put something like 2%, that is 6,000 rupees. But can you say that for a 4,500 rupees, the return would have come to 6,000 rupees or 10,500 rupees? Will it come for sure? Even if it is not 6,000 rupees, 3,000 or 4,000 rupees, would it have come for sure? You may ask. By adjusting the strikes and other thing. Very difficult to say. So that is where the difference between the ideal picture of buying an option to replicate a cash market exists. That is, the reality could be different from what exactly the theory tells about you. So you need to constantly think about that what is it that probably brought you down here. Okay, but what is it that you can try to do to avoid this. Okay, so one thing that probably that we'll look at it is we can look at the factors which can nullify this. What factors can nullify this? Suppose in this particular case, when you are buying an option, if you are buying a call option, you are buying volatility, you are buying a time decay, right? So what is it when you buy an option? You are buying volatility. So you are not only buying the direction, okay, you are not only buying the direction, you are also buying the volatility. Then you are also buying a time decay. So this will anyway be eating against you. This will always be negative against you because this time decay will always be eating it against you. Buying volatility can either help you or down. Okay, one day it can help you, one day it can go down. But what will definitely not help you is a time decay. So what is it that probably you can do to neutralize this? Today we will just leave you with some thoughts, but we will work out with some actual illustrations. How, suppose if you have done this this way over the period of say 1 month, what is the net result? This is what we are going to see at some stage later on. So now let us look at we are going to buy buying a time decay. Now now we want to neutralize that. Let us remove both the volatility. Let us remove this time decay also. So can we just do that? Still for an investment quite disproportionately lower than what you invest in cash market. In that particular case, the answer comes in spread option. Right? So what you want to do is you want to create a delta which is 0.25. Okay, let us say you want to create a delta which is 0.25, or you create, suppose if you create a delta which is 20, then for an 100 rupees movement, this will move by 2,000 rupees. For 100 rupees movement. So you still have to need some 3 lakhs you need to put in the cash market to do that, right? So for an 100 rupee movement in the cash market, let us say in Nifty B or anything 0.6, 0.7%, right? So you will get something like 2,000 rupees. Now here, the same thing, if you create a delta which is 20, okay, then in that case you should be able to get something like 2,000 rupees movement. So we should not look towards losing two things. One is, suppose if you are buying a call and you are selling a call, okay, that means you have bought volatility here, you also sold a volatility To a very large extent, you are protected. Maybe some small difference will be there depending on the strikes and other things. Not going into that. So, if you are buying volatility and selling volatility, to a very large extent, you have neutralized it. Similarly, you are also buying a time decay here. You are buying a time decay. You are also selling a time decay. So, to a very large extent, you will also be, if not complete elimination, to a very large extent, you are subduing the time decay also. So, right now, this means you are creating something which is very close to the cash market portfolio in terms of profit loss. In the case of just buying a call option, it is something, a path which is not known. You are not very sure. Something, whether the loss can be less, the profit can be more, or the profit can be same. The end result will be known only after you complete that particular month. Okay. Only thing is, very large difference may not come, but there can be a difference in between the cash market and that, approximately anything between 25 to 50%, either on the upside or on the downside. So you are not very sure as to how many contracts you should have traded to create exactly the cash market portfolio, because month to month this can vary. So it's not in our control, but you have to just go ahead with it, keep doing it consistently over a period of time. Probably you will have because in 1 month the volatility can be lower, time decay could have killed you, you might have made less money. In another month, the market would have taken off so significantly, volatility would have been great, the time decay would have probably would not have mattered much in terms of because of the huge volatility and price rally that took place. So all those things might have helped you to make more money. Question is, you can be consistent, and consistently you can have with a lower investment, you can just see maybe for 8-10,000 rupees compared to 3 lakhs. So keep investing that and keep seeing the result. That is one thing which probably you can look at that, right? So we will keep that in that picture in mind and leave it there. So now what is it that probably within a month, or whether it's a day, or whether it is a week, or this month or coming months, what is it that probably would have created almost like a cash market pool, almost some small difference will be there, is basically a spread option. That means why we are saying that with great confidence is, you are buying a volatility, you are also selling a volatility, you are buying a time decay, you are also selling a time decay. So what probably could hit you as far as option is concerned, those things are effectively neutralized. Now that means, what is an investment in that particular case? So the investment, is the margin, because you are creating an F&O spread trade. So what is the margin? What is the premium? Okay. So what is that investment? Okay. Now you're buying one option and selling another option. You know very well that these days for hedged contract, on the sell side of the leg, they are charging exposure margin is 1.5% of contract value. 1.5% of contract value. So suppose if you are selling a 15,000, okay, contract value is into 75. So what is that? 15,000 into 75 into 1.5 for one contract into 75 is 11,25,000 into 1.5%. So that comes to 16,875. So let's round it off to 17,000. Okay. Then of course the premium which is involved, the difference in premium, and assuming you are paying for the difference in the spread, assuming you are paying even 200 rupees. 200 rupees is the difference you are paying in the premium. Approximately I am saying into 75, this will come to 15k, right? So 15,000 and so approximately you may require some 31k or so. So what was the investment there? It was 3 lakhs. Okay, let us say you are creating a portfolio of same delta 0.2, so where the movement of 100 rupees gets you to 2,000 rupees. So you are now getting for 31,000 rupees compared to 3 lakhs, getting 31,000 rupees, and you are creating the same portfolio. But there is no ifs and buts. Only thing is, what probably will involve is that at some point of time, at some price spike, you need to keep, you need to roll over the option. Now, why I am saying this is that, let us say the market now, just as an illustration I am telling you, let us say you are done 14,700 call you have bought and 15,000 call you have sold. Okay, and let us say you have paid a premium which is approximately 180 rupees. 180 rupees. So let us say you just leave it just like that. You just leave it like this. Okay. Now, what will happen if the market goes up to 15,300? The market ends at 15,300. The profit that you would have got in the cash market, okay, the profit that you would have got in the cash market would have been something like 6,000 rupees for the same 3 lakhs because it has gone by 2% or so. In this case, the profit is, for 14,700, 15,000, you paid 180. So the difference is 120 rupees you will get. Right? 120 into 75, it's going to be much higher. Something like 10,000 rupees or so, right? So it's going to be 9K, 9,000. So definitely it is slightly more than this. But let us say the market rallies to 15,500 or 15,600, which is 4%. Just 4%. Then in this cash market you have got 12,000 rupees profit. Right? 12, because 3 lakhs, 4% in that. But here, since you have bought and sold, the gain would have stopped at 9,000. That means maybe at 15,500 or so, probably you need to you need to ensure that your profit also in the spread option also expands. Otherwise, your profit will become quite limited to the extent of only 9,000 rupees, whereas in the normal cash market you have got 12,000 rupees, right? So it will not create the exact portfolio. So it will need a sort of a rollover from you. That is, the option has to be taken and rolled it over to some higher positions. Okay. So from there again you should build on the profit. So let us say the market has come to 15,500, and from there if the cash market profit is going to expand more, so what you should do is you should wind this around 15,500 or so. Then in the case you should remove this, and at that point of time you should put 15,200, 15,500 call spread to further take you on the upside, to continue your movement on the upside with the same delta of 0.2. So always you should maintain the delta of 0.2. So whatever that gives you a delta of 0.2, you should continue to do that. So the question is, you should always maintain this delta of 0.2. You should do a spread option in order to ensure that the amount of margin that you pay is considerably less when compared to the cash market investment, one. And third thing is that you should always you should ensure that the portfolio that you have created in the option is rolled over at some point, at some level. Because if the loss is going to be more in this particular case, okay, then you need to be you need to the profit is going to be more in the case of cash market. Then why should you not capitalize it by rolling over the option, right? Why do you want to ensure that your profit gets stopped? So you should do that. So similarly, when the market, when prices fall down also, whatever extent of a cash market loss also will come here, and you need to roll over, because you are paid 180 rupees, 75 rupees normal option. If it is 180 into 75, so this will come to something like 12,000 rupees or so, right? 13,500. So in the normal cash market, this should come 4.5%, which means below 14,400 only. Okay. So if the market is 14,600 or 700, then in that case, you will not get you will lose the entire option premium that you have paid. So you should capture a considerable amount of option premium there also, right? So what you should do is, you should always keep in mind that you should always do a delta of 0.2. That means you should definitely roll it down the option, either in the upside or downside, but need not frequently, not for every 100, 200 rupees level, but maybe 200, 300 rupees down if it falls. Nowadays markets are very volatile. So, but generally speaking, Nifty getting by 200, 300 points lower is something in past periods never used to happen that frequently. It will be once in 10 days or so, market falling by more than 200, 300 points from the present level. Nowadays only we see the points, within a single intraday it's moving by 200 to 300 points. But it may need an adjustment. It may need some sort of an adjustment from you, that at some level you need to adjust that in the same of delta of 0.2 and ensure that the loss that you are having in the portfolio is not greater than the loss that you would have had in the cash market. So that is what is where you have to keep in mind, because see here you have to if you want to make a higher yield. See, let us say you want to make a higher yield. Okay, now you should be one is that you don't want to put less money, but you want to have a higher yield on the or return on investment. Definitely, you need to think about it in many ways, because in business, if you want to make your business work much more efficient, much more smarter and safe, and give extra money, definitely you need to put in a greater efforts, right? That's how business will be run. Similarly, in the same option, you don't want to put 3 lakhs, you want to put only 30,000, then definitely you need to, because if you can say that no, that was very simple and this is a little bit complicated for me to understand. Yes, it is a little bit advanced. I wouldn't say it's complicated, but you will enjoy it when you go through that, because if your savings, how much of money you would have invested there, 3 lakhs, you are investing only 30,000 rupees. Because of the investment on the saving, because you don't need to invest this much, we need to invest in something else. That something else is education, then implementation. If you do in one contract, you will come to know what are the pitfalls, what are the problems that you are facing. Accordingly, you will definitely improve. So now what we are looking at is that, see, the same thing which I told you that no, on the same option price of a delta of the same nature, today the market compared to Friday, it was flat, and hence the option lost value because of the time decay. In this case, it might not have lost. The same 14,000, 15,000 levels, if you look at it. See, what was compared to Friday? So Friday, 15,700 call, we lost 12 rupees, right? So 12 rupees is what we lost in 14,700, 1255. And let us say the same 15,000 today is the same value, 11,1140. That means we bought this 14,700 and we sold this 15,000, right? So there is no loss, absolutely, because we had 12,55. So because these are all some last minute adjustment. Otherwise, there is no loss. There is no loss in this. So if you look at any 300 rupees thing also, say 15,000 is 1140 here, and 15,300. Okay. 15,300, see, 11 rupees 10 paise. 15,300 is 11 rupees 10 paise, and 15,000 is 11 rupees 40 paise. No loss. No loss. Okay. So because of the flat market situation, now here also if you see 15,000, 1140 we lost, 15,600 we lost, 1325. In fact, we gained a little bit. We gained a little bit. So comparatively, this type of analysis, okay, helps you a lot in order to reduce your option premium that you are paying, and saves you considerable amount of investment amount that is required, and gets you the same return in the cash market. So if you keep working like this, so today is what? Today is 8th. So for a 25th option, you keep doing this from 8th to 20th. When it comes to 20th, last few days you should not go with a near month, near week. You roll it over to the next month. So just 4-5 days before, that is 1 week before, you just roll it over. Probably I would say you're doing from 8th, so you do till 18th, so that it's till next Thursday or so you do it, and then roll over the option to next month. Now let us look at the same thing for this week if it had happened like this. So today 10th March. So that day was 14,950. Because the near one will have a lot of things which can be positive or negative. So now when you come nearby, let us say that day, let us say you did 15,000 and 14,700. Say 14,700 today might have lost 23 rupees, and 15,000 lost 38 rupees. So in a flat situation itself, you still got 15 rupees profit. You got 15 rupees profit, but that day the price would have been 300, and this should have been 148. So 140, 150 rupees would have been there. So how exactly it would have fared over a period of this one. So all these things we need to see what probably could have been. But you just look at this particular week. There's a great amount of this one, that is the profit. Even in a spread option, in this particular case, the time decay in fact has helped you because of the near one. So there's a finer way of doing things, that know which strike you should take, which month, which week or which month you should take. All these things will be a little more carefully as to be crafted, but that is a little more, I would say, slightly more advanced as far as that particular thing is concerned. So I wouldn't like to go into that immediately. Okay, so let us look at the point of thing that as far as possible, the options replication can be done successfully through a spread option to get a cash market portfolio, okay, for a far lower investment. The only thing that would be called for is rolling over of the option at some level. So we will look at how we roll over the option, all those things, and then one more. We highlighted three phases. One is just buying a call option, just buying a spread, then buying a straddle. So the third point of buying a straddle to replicate a cash market portfolio, the advantages and disadvantages, and what is that spread option. So we will look at that next class and next session, and then one session we will look at an illustration, okay, for one or two or all the three. Okay. So thank you very much. Time is 7:50. So you can please ask your question. Now, somebody has asked a question. So, spread option, which one to entry first and exit? Where can I see delta value in which website I can see? So you can use optionprice.com. Say we have this one. So option. There are many sites. Okay, we are not propagating any particular site. This is it's called option-price.com. So if you put the underlying price is the futures price. Exercise price is the strike price which you have to put. Days to expiration, how many days? So today is 8th. 25th expiry will have 17 days. If you are taking underlying price as the futures price, interest rate should be 0. If a Nifty just put the dividend yield as 0, volatility is where probably you have to slightly experiment to get the call option and put option price. The call option put option price is there in the NSE website, right? For this particular strike, what is the call option and put option? So if that call option and put option price was to come, then what is the volatility? That you have to key in. Once you get that, you will have a delta. See, for example, delta 0.533. So you will have a delta of 0.533. So now you know this is the delta. So you can use this particular site or any other site in order to know what is the delta. Now, as far as which one to buy and which one spread option, which one to buy, the thing is that it has to be done instantly. I know if you are entering into a spread trade, you should just buy a call option, then you should immediately sell the call option, because either way if the price moves fast, then you'll get hit. So you need to do time, particularly when the market is a little bit steady, because in volatile situation, very fast movement takes place, which can hurt you as far as the option removal is concerned or the entry is concerned. In option, spread loss is limited or unlimited. Now, definitely, because the loss is always equal to the maximum the premium amount that you are paying. So beyond that, you are not going to lose anything. Okay, so that way it is limited. Profit is also limited because you are putting a spread option. So the profit will be limited to the extent the spread minus the option premium that you have paid. You will not have an unlimited profit also, because unlimited profit will come only if you just buy an option, plain option or plain futures. If in the call option, if the price goes up, and in the case of futures, if the price goes up, so that will give you unlimited profit. In spread option, the profit also will be limited to the extent of the spread is. If you have done a 200 rupees spread, profit will be 200 rupees minus the option premium that you have paid. Okay, I'll write for you. So, option -price.com. Option-price.com. Okay, there are In Google also, if you put option calculator, you will get many calculators. This is one calculator. Thank you. Thanks for your questions. So thanks for your participation. So we will have another session on Friday that will be mostly on the Fibonacci ratios to know what the targets for Nifty, Bank Nifty and some stocks are concerned. But this option we will again carry it next week, okay, with illustrations of past data. So please join us. Thank you very much for today's participation.